Welcome to TheoTrade. This is Don Kaufman. Here we are. It's December 9th, 2017, doing the weekend video. Let's get started this weekend with, what's been the topic of conversation inside really the financial world. And that is none other than, this Sunday, there's going to be the first listed Bitcoin futures at the CBOE. So that's the Chicago Board Options Exchange. The CBOE is going to list the Bitcoin futures. The following week at the Chicago Mercantile Exchange, the CME will list Bitcoin futures. I'm just going to tell you briefly about the Bitcoin futures because we've had so many questions. First and foremost, it's a futures contract. If you're going to be here on thinkorswim, the symbol is /XBT. Again, that's /XBT. Now, there's no charting information on them just yet, but they're here. They're ready, ready to fire off. A couple of things that are not totally clear yet are what are some of the margins going to be. There's a lot of different brokerage firms that are floating around ideas of having margin as much as 40 to 50%. The other aspect is what this is actually worth. At the CBOE, the Bitcoin futures are going to be trading the equivalency of 1 Bitcoin, whereas the Chicago Mercantile Exchange that's going to list again next week, when you trade one of the CME's contracts, that's going to be the equivalency of 5 Bitcoins. So if you think about it, let's say Bitcoin's going to be at about $15,000. Even if you're trading one of them, all right, and you're going to have to tie up maybe 40 or 50% margin, you're probably going to be looking somewhere in the neighborhood of anywhere from $6,000 up to probably about $7,500 in margin to trade again here at the CBOE. When the CME comes out, again, that's going to be the equivalency of 5 Bitcoins. Obviously, if Bitcoin's trading at $15,000 times 5, what is there going to be? A whole lot of margin. Your margin is probably going to be upwards of about $40,000 to trade a CME Bitcoin future. There's also many brokerage firms that are specifically talking about they're not even going to allow the shorting of the Bitcoin futures initially. That was actually one of the statements out of Interactive Brokers. So again, there's a lot to unfold. But one of the aspects that I kind of want to bring, to light is how traders are really going to make markets on here. So I have a close friend in the market making business in Chicago, and we talked a little bit, in the last couple of days about how they're going to make markets in here. And I'm going to explain that to you guys in a little bit of detail. So what you're looking at on the screen right now, we'll say over here, all right, over here happens to be the actual, Bitcoin exchanges. So you've got a Bitcoin exchange here where you're ultimately trading Bitcoin, and it could be really round the clock. On the other side, we'll say that this is the CBOE, and these happen to be futures contracts. So the way that market makers are going to handle this, the Bitcoin futures, as of now, are actually settled to cash. So if you hold a Bitcoin future to the expiration, what happens? It ultimately settles in cash. If you've got the Bitcoins themselves, Bitcoin is, a Bitcoin. And what the market making firms plan to do, they're going to turn around and they're going to make markets. A market means you have to be both a buyer and a seller. Now, the market making firm already has, a interface directly to the Bitcoin exchanges. So, and they'll use a multitude of different technologies over there. And what they plan to do is if you come in and you, for instance, buy the Bitcoin futures, that makes the market making firm have to sell the Bitcoin futures. So they're going to sell the Bitcoin futures, then they're going to go over here to the actual Bitcoin and they're going to buy a hedge against it. So it's going to be this constant cyclical hedge around. All right. Now, the Bitcoin futures, eventually, they've got hours, right? These things are going to close down. They're not open all the time like the Bitcoin exchanges are. So the moment that the Bitcoin futures close down, let's assume they're closed down, then the market making firm that's carrying inventory of the futures, they'll just continue to hedge round the clock over in the Bitcoin itself. So then when the market reopens, okay, then they do this tactical and cyclical hedge once again. The market closes, what do? They just hedge overnight in the Bitcoin. So most of it is an automated process. You know, this is not like the market making side of it isn't going to be heavily like with a market maker going, we need to buy 1,000 Bitcoins over here. So what I envision happening initially, okay, first of all, nobody's going to run right out of the gate and be like, yeah, we got to trade these things. I mean, not the market making firms, not retail clients. Like nobody wants to jump in and start trading a product. You know, somebody will step in, they'll trade a onesie, twosie. The volume will start to pick up in here. Initially, though, in the first few weeks, I actually expect the Bitcoin, all right, volatility to, in fact, be exacerbated by the futures contracts. Then just a few weeks or a few months down the road, what's going to happen ultimately is the arbitrage. And for those of you that don't really understand this terminology of arbitrage, I'll explain it in a little bit of depth over here. But what the arbitrage happens to be is you've got, again, over on the right-hand side, this happens to be the futures contract, all right? And here happens to be the Bitcoin itself. Can't write on here, but it happens to be the Bitcoin itself. The arbitrage is that there's going to be these like really small areas that they can capture, the market making firm can capture between where the futures contract is and where the Bitcoin actually is. I'll give you an example. Let's say the futures contract is trading at 15,250 and the Bitcoin happens to be trading at 15,200, for instance, and 30. What they're ultimately going to do is the market making firm will turn around, sell this, buy a couple of these, and they'll do it in both marketplaces, right? And the computer will ultimately get better and better over time, all right? Just like anything. And what they'll do is this arbitrage will become tighter and tighter. So ultimately, you'll see like a $20 differential once in a while between them. Yeah, well, within a few weeks or a few months, the differential will be nothing. Why? Because all of a sudden, we're going to just have a server-driven Bitcoin marketplace that's just going to feed directly back to the futures contract. So again, initially, I expect the volatility to be exacerbated. And the reason that I think there's going to be higher volatility initially in the Bitcoin is there's going to be a lot of retail, all right, and a lot of, again, a lot of firms taking actual positions in the futures, which is going to sway the Bitcoin higher and or lower. You know, there's a lot of people out there too that are just, they're chomping at the bit to want to get short Bitcoin. I got to tell you with that one, you are on your own. We all see it. We all know that there's, you know, bubblicious things going on in this marketplace. Yeah. You know, I've also been on the wrong side of bubbles before. It doesn't mean that the bubble can't double or triple before ultimately coming back down to reality. With that, all right, we're done with the Bitcoin discussion for right now. Kind of excited to see him open. You know, and I'm the individual though. This weekend, I'm going to stand back and let somebody else get their head taken off first. With that, let's get to the markets. All right, this week, the S&Ps. So you turn on kind of the mass media out there, they would make you believe the S&Ps exploded higher. But the reality is, what did we do? Okay. Well, instead of looking at the S&P futures, maybe we're a little bit more comfortable looking here, which is the SPX. Now, each and every week, we kind of draw these expected moves. And this past week, we had increased implied volatility, right? We were looking at about a $35 move higher or lower. Now, this coming week, all right, we're just below about a $25 move. So we'll just make this about a $25 move, just so you can see the differential of volatility. Last week, we're expecting a lot more, you know, movement. This week, it tapers it down a little bit, right? So big volatility followed by, well, $25 expected move is not exactly, you know, earth-shattering. But as I said, the entire marketplace, it kind of felt like the media was like, look at this rally. Well, look at what rally? I mean, if you take a look at the S&Ps, in fact, I'm going to zoom in just to kind of show this to you in a little bit more detail. If you take a look at the S&Ps last week, you know, we closed at what, 2642. And, by the end of the week, we were at 26.51. Like, is it a massive rally? No, not really. All right. And it wasn't a massive rally. You kind of dribbled to the upside a little bit by 9 or 10 points inside of the SPX. And again, I like to use these expected moves and, the price action from week to week just to give you a better orientation of the markets. Then we come over to the Nasdaq. The Nasdaq early in the week, it struggled. So if you look at the Qs ultimately, what did they do week over week? Absolutely nothing. I mean, the Qs pretty much closed out and, finished this week precisely where they finished the previous week. Last but not least, one of the markets that just doesn't get enough love, but I love it, the IWM or the Russell. The Russell closed quite a bit lower. In fact, the Russell even broke through the bottom portion of the expected move. Okay, this is Monday, Tuesday. Here is Wednesday, and Wednesday we actually cracked the expected move. It was a little bit of Mr. Toad's wild ride here earlier in the week before bouncing back up ever so slightly into its expected move. And again, I like to always start with that before we get too detailed, into the weeds of the marketplace. So what did we see this week? Well, for the most part, the S&P is a bit higher, the Russell a bit lower, and the Qs massively unchanged. Okay, so not a huge amount of action. Now, immediately with that, I want to be forward looking. History, it's great. So one of the things that changed this week and that I am forward looking on happens to be the volatility. Okay, the VIX came off big time. It's all the way back down to like 9.5, which kind of begs the question, if you have December volatility positions on, you still got 10 days left. That's fine. Okay. But I'm already thinking about, before I've even taken off the December positions, I'm already thinking about putting positions on for January. Why? Well, when it comes to volatility and positioning yourself in volatility, you have to kind of strike, when it's hot. And in this case, you have to strike when volatility is extraordinarily low. So I'm looking at building a couple of different volatility trades over here, one of which I'm looking at selling. Again, we're going to come in here and we're going to sell the 11 put. All right, so selling the 11 put, they're trading for about 45 cents. And then I'm going to take that and I'm going to use it to finance probably the purchase of about a 14, maybe 19 spread. Okay, so again, this is, for those of you unaware, this is a spread that we've talked about, pretty considerable amount recently. Now, let's come back to it here. So we're financing the cost of a spread by selling the 11 puts. The entire trade is done for about even money. It's what we call even money. So if you want to take a look at this in terms of the analysis of the trade, we'll open up to this. Okay, and this is kind of one of our VIX volatility spreads. This is kind of what it looks like in terms of the analysis. So right here is where the VIX happens to be. If the VIX spikes higher, we're profitable. If the VIX absolutely tanks, we're going to lose capital. But we all have to remember that the VIX, yes, we're selling an 11 put. Okay, we're selling an 11 put, and effectively we're doing it for nothing. The lowest print ever on the VIX, okay, the lowest print ever on the VIX happened to be 9.1. That is what we call the settlement. That's the lowest settlement. If you ever want to look at the settlement, it's under symbol VRO. That's the settlement for the VIX. The lowest one has ever been 9.1. So this trade has got a pretty effective risk reward over there. But I wanted to just throw that out there. Sometimes these trades can get, people, it's a little bit deep for you. That's all right. Okay. Here at TheoTrade, go through some of the classes. And again, that's the VIX volatility spread, to learn effectively not only how to place it, how to execute the trade, how to allocate capital, but also, of course, how to exit the trades most effectively. Now, the reason I'm kind of looking for that VIX volatility spread is first of all, there's an assumption that nothing is going to happen into the end of the year, but that couldn't be further from the truth. Lots of volatility has occurred in the month of December. Now, you don't even have to look back too far to see just that. When I say lots of volatility can occur in the month of December, and, look back over here, the last time we saw some decent volatility into the month of December, you only really have to look back, and this is into 2015, where markets were kind of topping out. started to see some fairly tumultuous trade, and we slid heavily into the end of the year. So again, the idea that there can't be volatility is neither here nor there. Not to mention, all right, listen, there are a lot of things that are going to be happening in the next few weeks. In fact, this coming week, which is the next point I want to make, this next week, we're going to be looking at the calendar here, and evidently there's an FOMC meeting. All right, so that'll be out on Wednesday, but we're also going to look at the ECB announcement, and this is the Bank of England announcement and minutes. And I'm going to show you something interesting on this front. If we cruise back over to the SPX for just a moment. So there's an FOMC announcement, and that's all you're going to hear. That's all you're going to hear, you know, in the media the entire week. What is Yellen going to do? I'll tell you what Yellen's going to do. She's going to be retiring in a couple of weeks. Hanging it up. By the way, she's probably not going to retire, but she definitely will be done with the FOMC as Jerome Powell comes in. I just want to show you something interesting because you're going to have to listen to this in the media the entire week, but here's a Wednesday expiration. You know, on the Wednesday expiration, the volatility is 7.78%. You know what that means? It means nothing. They're not expecting anything to happen with the FOMC announcement. I guess the irony of that, they're expecting more to happen with the ECB announcement. And you'll see Friday's volatility, even though the ECB announcement, and I'll make this clear, so not to confuse anybody, the ECB announcement comes out on Thursday morning. But there is no Thursday expiration in this case. The Friday expiration is displaying some extra volatility packed into it. Why? Because the markets are actually anticipating much more what Mario Draghi in the ECB. Mario Draghi, that's who runs, again, the European version of the Fed. I prefer to call him Ivan Drago. All right, it's Rocky 4. Anyway, with that, about 8.8% implied volatility. So the ECB announcement seems to effectively mean more. Again, that could drive a little bit of volatility, but let's put this into context over here. We're not even expecting, as I said, a $25 move this week. All right, the next thing I want to talk about before kind of wrapping things up here on this weekend update is, are we going to see some continuation of volatility inside of the Nasdaq specifically? All right, so I'm going to take the expected moves off the screen here momentarily. All right, let's move away from expected move. And I want you to recognize the Nasdaq here with some fairly wild, okay, swings in the last 2 weeks. Yes, it got a bid back under it, but I'll remind you that the Nasdaq as a whole, for the most part this week, finished unchanged. Okay, there has been weakness followed by just, again, as I said, wild volatility in underlyings like Apple. If you're into trends and so forth, Apple is effectively in the shortest duration here in a bit of a downtrend. Now, I know that everybody tends to be a little bit myopic on this front. They'll look at something like Microsoft. They will look at Apple. Okay, they will look at Facebook. All right, they'll bring up Google, Amazon, and all of them look rather healthy on a relative basis, right? They all got whacked back, got bid back up. Amazon did it. Okay, Google did it. Facebook did it. If you're taking a look at Amazon, Amazon is still well off its all-time high over here. But hey, we've seen this thing move $40, $50 in a day. However, I'm going to show you something in kind of stark contrast, and that happens to be none other than Intel. And Intel supported a huge amount, okay, of that last push coming out of summer. Okay, the last really big push up in the Nasdaq. Intel is incredibly weak on a relative basis. In fact, so weak that any bid higher in Intel, if I can get a bid up in Intel, and what I'm looking for, and I'll be really specific here, if Intel can get bid back anywhere near 45, I'm actually going to go ahead and short it, probably with an in-out spread, looking for it to cave ultimately back in. I'll remind you throughout the course of this next week, keep eyes on Intel. I use Intel as overall health of the Nasdaq marketplace. It is a fairly behemoth market cap. It's not a Google, okay? It's not a Microsoft, but it's a fairly behemoth market cap, and on a percentage basis is starting to make a dent, okay, in ultimately what? The Nasdaq marketplace. I want to thank everybody for joining us here on this weekend update. You can always reach out to us, support@theotrade.com. Have a wonderful weekend. Bye-bye, everybody.